Hey everybody, welcome to the Chapter 12 guided assignment. So this is us dealing with dividends of stocks. So this is the Yosemite Bike Corporation. They make mountain bikes and they sell them all over the place, and that's enough. Anyway, I don't need to read all of that. They've declared the following dividends over a 6-year period. And then during the entire period, the outstanding stock of the company was composed of 25,000 shares of preferred stock, which was 2%, $90 par, and 100,000 shares of $4 par common stock. So what we need to do then is determine our total dividends and the per share dividends of each class over the 6 years. So the first thing that can be really helpful to us here is for us to know how much our preferred stock should be paying, because this is a cumulative preferred stock. That means that it's kind of guaranteeing a certain amount of dividend to the preferred stockholders. And if it can't pay that much, then we're gonna owe the amount we couldn't pay to the preferred shareholders in the next year. So the easiest way to do that is when a preferred stock is 2% of a certain par amount minus $90, we can just take that $90 times 2%, and that tells us that they're guaranteeing $1.80 per share to the preferred shareholders in dividends. If I multiply that by the number of shares, I get $45,000. So the minimum dividend that's going to go to the preferred shareholders each year is $45,000. And that means if they don't pay out that much, then we're going to have to remember that. And in a year where they do pay enough total dividends, we're going to have to catch up on those preferred dividends before we can pay any to the common shareholders. So for example, in this first year, they pay $23,750 in total dividends. And so that doesn't reach the $45,000 minimum. So all of those dividends are going to go to the preferred shareholders, and none of the dividends will go to the common shareholders. To figure out the amount per share that is, we'll do 23,750. So the amount of dividend paid divided by the number of shares, 25,000 preferred shares, which means we are paying 95 cents per share dividend to the preferred shareholders and $0 per share to the common shareholders. In the next year, they only pay 10,250. So again, all of that's going to go to the preferred shareholders because there's not enough left over. There's not any left over to go to the common stockholders. So to figure out the amount of per share dividend that is, it's 10,250 divided by 25,000 shares, or 41 cents per share. And $0 per share goes to the common shareholders. So in the next year, 2013, they're finally paying enough dividend that they'll cover all of the amount that was owed to the preferred shareholders. So there's a little bit of a process we have to go through here, because we're guaranteeing, because this is cumulative preferred stock, it means they're going to pay back any amount owed to the preferred shareholders before they can pay something to the common shareholders. So what we're going to do is we're going to say, all right, in the first year, they promised $45,000 to the preferred shareholders. They paid out $23,750 to those preferred shareholders. So at the end of that first year, they still owed $21,250 to the preferred shareholder. Then in the next year, 2012, they promised another $45,000 to the preferred shareholders, and they only paid out $10,250, which means at the end of that second year, they owed $56,000 to the preferred shareholders. Going into the third year, they promised another $45,000 to the preferred shareholders. So now the preferred shareholders are owed $101,000 before we can pay anything to the common shareholders. So we're going to go ahead, and since we're paying 126,000 in total dividends,
So if you think about it,
so, we're going to go ahead and pay all of that back, dividends in arrears from our cumulative to our cumulative preferred shareholders. We're going to do 101,000. That's the amount that's owed to them. And since we're paying 126,000 in total dividends, then 126 minus 101 is $25,000 will go to the common shareholders. So now to figure out how much that is per share, we'll take 101,000 and divide it by 25,000 because that's the number of preferred shares. So they're paying $4.04, the preferred shareholder. And then here we have $25,000 being paid to 100,000 shares of common stock. We'll say 25,000, the amount of dividend being paid divided by the number of shares of common stock, which is 25 cents per share. So at this stage now, the preferred shareholders aren't owed anything from past years. So in the next year, we'll just pay that guaranteed amount of 45,000 to the preferred shareholders. We divide that by 25,000 shares, it comes out to $1.80. And then anything left over, 50,000 in this case, which is 95,000 minus 45,000, will go to the common shareholders. If we divide that by 100,000 shares, we get 50 cents per share. This next year, we'll pay our 45,000 minimum. That's $1.80 per share. Anything left over, so 15,000 minus 45,000, $70,000 to the common shareholders. Divide that by 100,000 shares, get 70 cents. And the next year, 45,000 to the preferred shareholders, which is $1.80 per share. And then whatever's left over, so it should be $125,000 to the common shareholders, which should be $1, divide that by 100,000 shares would be $1.25 per share. We can add all this up. That will tell us how much per share each of the categories of shareholders received. So for the preferred dividends, we got 95 cents plus 41 cents plus $4.04 plus $1.80 plus $1.80 plus $1.80 gives me $10.80 per share over that 6 years. The common is 0.25 cents plus 50 cents plus 70 cents plus $1.25. So over that 6 years, the common shareholders got $2.70 in dividends. It tells us to figure out the average annual dividend. So honestly, all we'll do is take this total amount, divide it by the 6 years. We can do $10.80 divided by 6 years, which should come out to $1.80 because we're all caught up with the preferred shares, but I'll double check. Yep, that's $1.80 per share. And then for the common shareholders, we can take $2.70 divided by 6 years, 45 cents per share. All right, the final question is, well, I'm going to check my work since I'm going to have to use this information in that last one, just to make sure I'm on track, which I am, but it's good to check. And then our preferred stock, it says, assuming a market price of $100 for the preferred stock and $5 for the common stock, determine the average annual percentage return on initial shareholder investment based on the average annual dividend per share for the preferred stock and for the common stock. So really what we're doing is we're going to take our average for the preferred, it was $1.80, and divide that by the market price of 100. So that's going to give me 1.8%. For the common stock, I'll take my average 0.45, divide it by the $5 price of the common stock, and that's going to be a 9% return. So even though the common shareholders are getting less dividend overall, based on the market price of the stock, they're actually getting a better yield. They're getting a 9% dividend yield, which is actually in real life a really nice dividend yield. And that's it. So hopefully that one wasn't too bad for you. As always, if you have questions, don't be afraid to email me or reach out in some other way.